Disney earnings meeting Wall Street estimates. The company reporting adjusted earnings of $1.87 per share versus estimates of $1.95 per share. Revenue also coming in below those Wall Street estimates. Revenues of $15.23 billion, just a hair below the $15.34 billion that's estimated. Now, looking through, first, I'm just going to tell you what the quote is from Bob Iger here. He says they're pleased with the results, including double-digit increase in earnings. He says, having earned the overwhelming support of shareholders, we are more enthusiastic about the 21st Century Fox acquisition than ever and confident about our ability to fully leverage these assets. Now, if you look at the factors that were driving the disappointing results at the film studio, they say growth was partially offset by film cost impairments related to animated films that won't be released. Last quarter, they did close Disney Toon Studios. No mention of Solo. There was some speculation that there could be a write-down on Solo. And then just looking at one surprising area of strength is actually the broadcasting business. Broadcasting operating income and revenues both growing much better than expected. Broadcasting revenues up 11% in the quarter, while operating income for broadcasting grew 43% in the quarter. Cable networks revenues up 2%. Cable networks operating income lost 5%. So the one segment that really outperformed expectations was broadcast, whereas which drove media networks overall higher. Whereas the cable numbers were a little lighter than expected. And I'm sure we'll hear more about cable and the outlook in terms of subscribers, et cetera, on the earnings call. It's interesting here looking at the Disney results and that cable network division, which is always under so much scrutiny for the question of cord cutting. It says here that there were some additional costs associated with the launch of ESPN Plus. We're hoping to learn more about this new direct-to-consumer ESPN Plus service and how it did in that earnings call. But they said the increase at ESPN was due to affiliate revenue growth and then some various other things, comparisons to severance, et cetera. But they said that lower advertising revenue at ESPN was due to a decrease in impressions from lower average viewership, partially offset by higher rates. So this ongoing thing where fewer people are watching, in part because of cord cutting, and then you have the higher rates to partially compensate for that. And they also say there was one less NBA final game. So there are a couple of these things in the quarter, for instance, like fewer weeks of spring break in the quarter, but still the overall number is just slightly less than the Wall Street expectations. I do think it's worth noting that Disney does not give guidance. So a lot of analysts, I think, would like for Disney to be giving that guidance. But a lot of these topics are going to demand follow-up questions in the call.
Did I hear you say at the beginning, Julia, that there was, it sounds like a lumpy number for spending when it comes to the rollout of the OTC for the ESPN app? Did I hear that correctly at the beginning?
Yeah, so there was BAMTech, which is that tech company they bought that specializes in streaming live sports. They said there was an operating loss in the quarter because of that investment, higher marketing costs, but also that investment to create that direct-to-consumer ESPN Plus service, which launched in April. So interestingly, this is the first full quarter where we could get results on how well that service is doing. No indication of how many subscribers it has, but hopefully one of the analysts will ask that on the call.